At the precise moment of this recording, Opendoor Technologies, ticker symbol OPEN, is trading live at $7.25, facing a significant intraday decline of approximately 5.8%. The market is currently open, and we are seeing a wave of selling pressure that has pushed the stock down from its opening level of $7.52. This isn't just a quiet drift downward. The volume is heavy, with over 21 million shares changing hands already, signaling that the battle between the bulls and the bears is heating up in real time. Most retail investors looking at Opendoor today see a beaten-down stock that just can't seem to catch a break. The general expectation, the narrative you see on social media and in hopeful forums, is that lower interest rates are coming, and therefore Opendoor is destined to explode upward because cheaper mortgages mean more home sales. That is the expectation, a simple linear relationship where the Fed cuts rates and Opendoor prints profits. But the reality is far more complex, darker, and frankly more interesting. The reality is that Opendoor is currently undergoing one of the most aggressive, high-stakes corporate experiments we have seen in the real estate sector in decades. They aren't just waiting for rates to drop, they are fundamentally trying to delete their old identity as a capital-intensive home flipper and rewrite themselves as a high-margin software business. Whether they can actually pull this off before their cash pile burns away is the single most important question for your portfolio right now. Let's talk about what is actually driving the price action today. The drop we are seeing to the $7.25 level is a reaction to a cooling of the meme-like fervor that gripped the stock just last week. We saw a massive surge recently driven by the hope of a December rate cut from the Federal Reserve. But smart money is realizing that a 25 basis point cut doesn't magically fix a frozen housing market overnight. The spread, the difference between what Opendoor buys a house for and what they sell it for, is still under immense pressure. When you see the stock down nearly 6% today, it is the market pricing in the realization that the pivot to an AI-centric model is going to be messy, expensive, and slow. But here is the angle most people are missing, and it involves something incredibly rare in the stock market: the recent warrant dividend. If you are holding Opendoor, you might have noticed some strange new tickers or line items in your brokerage account: Series K, Series A, and Series Z warrants. This was a move that baffled a lot of analysts. Instead of a cash dividend, which they cannot afford, or a stock buyback, Opendoor essentially printed lottery tickets and handed them to their shareholders. They gave you the right to buy more stock at significantly higher prices: $9, $13, and $17 in the future. Think about the psychology of this move. Management is essentially telling you, we believe our stock is going to double or triple, and we are giving you the option to profit from that if you stick with us. It's a loyalty test. It is also a way to keep retail investors engaged without spending a dime of actual corporate cash. This is the kind of financial engineering that either looks like genius in hindsight or like a desperate attempt to keep the ship afloat. Today's drop to $7.25 makes those strike prices of $13 and $17 feel like a distant dream, and that gap between the current price and the warrant strike prices is where the tension lies. If you were looking at Opendoor as just a house flipping company, you were looking at the old Opendoor. The narrative the new CEO, Kaz Nejatian, is pushing is that Opendoor is now a software and AI company. This is where we need to be very careful and separate the corporate gloss from the actual business mechanics. The claim is that by using AI to price homes more accurately and by automating the inspection and transaction process, they can drastically reduce their overhead. They want to be the Amazon of real estate, where the transaction is instant, seamless, and digital. However, the friction here is physical. Unlike Amazon, which moves cardboard boxes, Opendoor moves houses. You cannot digitize a leaky roof. You cannot write code that fixes a cracking foundation. The company is trying to impose software economics on a hardware reality. They are cutting reliance on human consultants and trying to let algorithms do the heavy lifting. The risk, and it is a massive one, is that an algorithm might overpay for 1,000 homes because it missed a subtle neighborhood trend that a human agent would have spotted immediately. If that happens, Opendoor ends up holding hundreds of millions of dollars in toxic assets. That is the bear case that keeps institutional investors awake at night. Speaking of institutional investors, the activity behind the scenes is fascinating. We have seen massive divergence in who is holding this bag. On one side, you have quantitative giants like Jane Street significantly increasing their stake recently. These are mathematically driven firms that don't care about the story of the house, they care about the volatility and the arbitrage opportunities. They are betting on the chaos. On the other hand, we have seen traditional asset managers like BlackRock paring down positions in certain funds, likely de-risking because the path to profitability is still pushed out to 2026. When you see a stock like Tesla stock or Apple stock, the institutional consensus is usually uniform. With Opendoor, it's a war zone. You have smart money betting on a breakout and smart money betting on a collapse at the same time. Let's look at the financials that were released in the third quarter, because they paint a picture of a company in hibernation. Revenue was down significantly, hovering around $915 million. For a company that used to print billions in revenue during the housing boom, this contraction is startling, but it's also intentional. They are buying fewer homes on purpose. They are trying to avoid catching a falling knife. But the net loss is still the sore spot. They are losing money on a GAAP basis, and while they talk about adjusted profitability, as an investor, you cannot pay your bills with adjusted EBITDA. You need real cash flow. The company is burning cash to keep the lights on while they build this new AI infrastructure. The debt situation is the other elephant in the room. Opendoor has a significant amount of convertible notes. These are debts that can turn into stock if the price goes high enough. But if the stock stays low, it remains a debt obligation that needs to be serviced or refinanced. They recently engaged in some debt restructuring to push maturities out, which bought them time. Time is the most valuable asset Opendoor has right now, more valuable than the houses in their inventory. They need time for the Federal Reserve to cut rates, time for the housing market to unfreeze, and time for their software pivot to actually start working. Why is the stock down today specifically? Aside from the macro cool-off, there is a growing realization that the winter real estate market is going to be brutal. Seasonality is always a factor. Nobody buys houses in December. But this year is different. The lock-in effect is still real. Millions of Americans are sitting on 3% mortgages and simply refuse to sell, meaning inventory is low. Opendoor thrives on volume. They need liquidity. They need people moving for jobs, for divorces, for upsizing. When everyone sits still, Opendoor starves. The intraday drop we are watching right now is the market pricing in a very, very quiet Q4. Now, I want to challenge you to think about your own position in this stock. It's easy to get caught up in the hype of a short squeeze or a meme rally, but you have to look at the fundamentals of the business you own. Comment below how many shares of Opendoor you currently hold, and more importantly, tell me if you actually received those warrants we talked about earlier. Did you get the Series K, A, or Z warrants, and do you plan to exercise them if the price hits, or are you just going to sell them on the open market? I want to see what the retail sentiment is actually like down in the comments section. Let's expand on the AI aspect, because this is where the future value of the stock will either go to 0 or 100. If Opendoor can successfully license its technology, if they can become the operating system for real estate that other agents and brokers use, then the valuation changes completely. Right now, they are valued like a risky real estate portfolio. If they become a SaaS company, their multiples expand. They could trade at 10 times revenue instead of 0.5 times revenue. That is the blue sky scenario. But to get there, they have to survive the muddy ground reality of owning thousands of homes in a depreciating market. We also need to discuss the competition. You might think of Zillow or Redfin as competitors, but Opendoor's biggest competitor is the traditional real estate agent, the local agent who knows the school district, who knows the baker down the street, and who can hold the hand of a nervous first-time buyer. Opendoor is betting that people value speed and certainty over that human touch. They are betting that you'd rather click a button and get a cash offer than deal with 6 months of open houses and staging. In a hot market, that's true. In a cold market, people get desperate and might want the certainty Opendoor provides, but